The trend is multiples arbitrage. Buy a private asset at 20 times, listed at 35 times. We eat all kinds of terrible things and we have terrible lifestyles. So this is just something that every Indian needs to be more aware of, and we all need more healthcare. And anyone who provides it and provides it at a cost that's affordable is an investable asset. So, for example, we're under a process right now to expand. And the time it has taken for us just to get to a point where machines are on site to start digging and building a hospital.
The most difficult thing for them to do is change behaviors, because ultimately a hospital is a practice. A practice is a collection of doctors working together to treat patients. Even today, we don't have enough capacity to treat cancer in India.
That if we were to run it in the way that we run any of our hospitals, we would run it to the ground, because we would overload it with costs and overhead and so on. Hospitals across the world, go to US, Europe, UK, wherever you want, the technology stack we use is archaic. Why are all the hospitals concentrated in tier 1 cities? It's what that person said about the bank robber. That's where all the money is.
So they have a product called Claim Book. It does address a part of the patient's journey. If they're insured, they need a pre-authorization. And so what Claim Book does, it's fully automated. It's agentic AI-based platform, and it dramatically reduces the need for human intervention. So it has cut down discharge time.
We can break even at a much smaller catchment area, which is just at a city level, and run it in a very differentiated way.
In the recent few years, we've seen a very strong consolidation trend happening in tertiary care. If you look at the private equity world, you have the likes of Blackstone acquiring assets, merging them. Even within strategics like yourself, whether it's yourself, Manpower Group, Max, we've seen you all be acquisitive of smaller hospitals across the country. What trend is playing out in tertiary care? Is there a strong consolidation trend? And what are some of the implications, I guess, we should think about through this consolidation?
Sure. The trend is multiples arbitrage. Buy a private asset at 20 times, listed at 35 times. That's a tried and tested playbook that will never go out of style. The larger narrative, obviously, is that this is a market with very substandard availability of healthcare in the public sector and very growing private sector, but nowhere close to what the average country needs. As Indians, we're genetically more vulnerable to all sorts of diseases. We stay in a very polluted environment. We eat all kinds of terrible things, and we have terrible lifestyles. So this is just something that every Indian needs to be more aware of, and we all need more healthcare. And anyone who provides it and provides it at a cost that's affordable is an investable asset.
And so far, has there been good proof points that the acquisitions have been a better way to expand market as opposed to growing greenfield?
So, for example, we're under a process right now to expand. And the time it has taken for us just to get to a point where machines are on site to start digging and building a hospital is 2.5 years. Add another 2.5 years for construction, and another half a year for all the licenses, permissions, and 2 years for break even. And then you start to understand, okay, acquisition, even if I'm paying 30-40% more, it's sort of worth it because I can see the results on my balance sheet immediately.
Okay. And Hari, from your perspective in this consolidation trend, one of the biggest thesis we hear from private equity firms looking at healthcare assets is they want to change the mix of services offered, so move towards more high-yielding surgeries such as oncology. What are the key levers, or sometimes at points it's about driving pricing rationalization. At some points about bringing in the headquarters cost structure. What are the 3 or 4 levers that you think are going to be very important to play out for this consolidation trend to prove itself out?
I guess just to back up a little bit, couple 3 other trends I think that are driving this consolidation. It's very competitive in the metros, right? A lot of these big healthcare provider networks are primarily located in metros, in the 6 top cities in India, but bulk of the population lives outside the metros. And now that the metro market is more or less, I would say, I don't want to use the word saturated, but there's just a lot of capacity. I think there's a move now out into tier 1 cities, tier 2 cities, right? And to Viren's point, It's faster to acquire. And complementing that is succession. There's a serious issue. A lot of the doctors are now ready to retire. They own 100-bed, 200-bed hospitals. Their kids are not interested, so they want to cash out. So there's a willing buyer, because if you just look at capital market performance of healthcare stock, they've delivered enormous value for investors, right? And so that's Viren's point about private-public arbitrage of multiples. So you have a lot of capital that's now interested in healthcare. We have willing sellers because of succession issues. There's intensifying competition in metros. So now coming to your question, if the acquirers want to then create more value from the acquisitions, there's a few things. One, they have to deal with that succession or the lack of layer two, right? Because at some point, for example, you buy a hospital in Nagpur or you buy a hospital in Anantapur, the founder is going to retire. And a lot of times that particular hospital is associated with the founder or the founding team. How does then one transition the brand from the founding team to the acquirer's brand, right? So that's one. Second, generally speaking, what we find in small mid-market healthcare provider networks, the systems and processes are not as robust. A lot of heavy lifting is required to fix the processes, so that ultimately the brand equity is built around ensuring there's a good clinical outcome, right? And the word of mouth plays a very important role in choice of healthcare providers. So it's very important to ensure that the patients actually don't move away from that hospital after the acquisition because they feel that quality has deteriorated or that personalized touch is missing, whatever may be the reason why they like that hospital in the first place, right? So they need to ensure that they don't lose that while they put in place processes to ensure quality and repeated, repeatability in results and clinical outcomes. And then the most difficult thing for them to do is change behaviors, because ultimately a hospital is a practice. A practice is a collection of doctors working together to treat patients. And they've all sort of done it for years before the hospital was acquired as part of the consolidation trend. And they're used to prescribing certain brands of medicines. They're used to scheduling surgeries in their OT in a certain way. They expect certain nursing support. And sometimes it may not work in a larger corporate setting. So how do you change behaviors and integrate that, put in place different culture? Very difficult to do. So it remains to be seen how this plays out.
No, great. And another trend I'd say which has been very prominent over the last few years is seeing single specialty delivery models come up. And Hari, you've been a very early investor in eye care, fertility care, skin care. Can you share a bit about, I mean, you've been investing in it for the last 15 years, but have these single specialty scales at this point reached a scale where they can absorb the kind of capital that they're looking at today? Eye care is an example. We're seeing a lot of investments going in. So which of these verticals you feel remain undertapped today?
So this is a longish answer, so bear with me. We did our first single specialty network, Healthcare Global, which is now listed in 2007.
Yeah.
Everybody thought we were crazy. And this was cancer, right? So now it's India's largest private network of cancer hospitals. And the reason I bring it out is even today, we don't have enough capacity to treat cancer in India. The daily incidence and the prevalence of cancer is way more than the capacity. Way back in 2007, when we wrote the IC memo, based on that prevailing prevalence and incidence, we estimated that India needed 800 linear accelerators to deliver radiation treatment. When we exited HCG 7 years later to Temasek, we only had about 80 or 90 installed, right? Another example is ophthalmology. So we did Dr. Agarwal's, which is now listed. That was in South India. Many moons later, we did Sharpsight in North India. And when we did Sharpsight 3 years ago, we found that the backlog of cataract in Uttar Pradesh, Bihar, and National Capital Region was about 1 million cases. Since then, that has actually increased because we just don't have enough. So healthcare in India is not a demand side problem. It's a supply side issue. And so almost you pick ophthalmology, oncology. We've built out India's second largest network of neonatal and pediatric ICU after Rainbow. We're just there in second largest in India, just 2 states, right? So I think any single specialty which need not exist inside a general hospital model right now is in short supply.
And Viren, from your perspective, within the Narayana Health Group, are there any particular verticals or single specialties that you're parallelly looking to build out?
See, the thing about single specialty, it implies that it exists outside of a hospital and can stand on its own 2 feet. The ones that generally tend to do better in single specialty are the ones that get, the departments that get commoditized because the science is not evolving any further. At least the rate of change of science. So ophthalmology, the reason it doesn't exist inside the hospital is because the margins are not sufficient for us to allow them inside the hospital. Same with dental, skin, dialysis. These are businesses that are extremely commodified, have decreasing margins, and therefore make sense you spin them off. For a hospital group to look at single specialty, can the Four Seasons run a McDonald's sort of business? Probably not. But it doesn't mean that there are businesses that we wouldn't try to run as single specialty. So we recently made an investment in medical oncology. This is retail chemotherapy in setting. But I know for a fact that if we were to run it in the way that we run any of our hospitals, we would run it to the ground because we would overload it with costs and overhead and so on. Investors love single specialty hospital because it's very easy to model out on a balance sheet. It's, you can make the Excel file. It's very easy to say, okay, per clinic, this is the rental cost, this is overhead cost, this is how much you'll grow, 5% rent increase, 12% revenue increase, model it out forever. You got a perfect business. For us, it's a little hard because of the variabilities that exist in this business, and hospital services tends to only make sense at margins of 25+%, which a lot of single specialty, given the commodity nature of the business, is very hard to achieve over long periods of time.
Okay. Thanks. And within Narayana Health, you all have also started an insurance business as well. Do you anticipate any new verticals, whether, for example, it's dental care or whether it's home care, any of these type of services, healthcare delivery services, to now start benefiting and growing because of insurance?
No. I mean, insurer, see, it's hard enough to cover the normal range of services that requires hospitalization. Most health insurance in India is catastrophic in nature. Very little health insurance pays for preventative care, pays for outpatient care because of the fraud problem. ICICI, for example, a long time back offered to pay for medicines, but then it had such huge claims numbers because people were handing out their insurance cards to their neighbors, to their uncles, for anyone else to use. We run a closed network insurance. The reason we're running it as part of a listed hospital group is because that's the only way we know how to control the claims and do it in a more manageable way.
Actually, it would be helpful. Can you describe a bit about how your insurance business is a bit different than what are the other options available in the market today?
Yeah. So this is limited in where it is sold. So for example, our insurance plans are not sold nationally. It's only sold in the places where we have coverage. And there's a heavy bias towards you getting treated in a Narayana-owned or a Narayana-affiliated hospital group. You go through that experience, it is seamless. You don't have any questions asked. You get everything done for you. We also have a huge amount of medical underwriting. Ours is one of the only insurance companies where we actually put you through a medical checkup. You don't have a broker who's just ticking lines on a form, and for you to be pleasantly surprised 3 years later when you're making a claim that you get denied because you missed out on something in that. So we do proper underwriting, and our goal is to keep you healthy. But what that means also is that we will not raise any issues when it comes to the claim tomorrow. Now, that is different because most insurance thrives on sales. You need national scale, you need brokers, you need distribution. And so the numbers make up for all your sins. Whereas for us, we think that we can break even at a much smaller catchment area, which is just at a city level, and run it in a very differentiated way.
Okay. Hari, another trend we've seen more recently is rising interest in CDMO opportunities. Can you share a bit about how this landscape has changed? I mean, you've been investing in API companies, formulation companies for several years now. How has that landscape changed today in the current geopolitical environment and current global supply chain?
I will answer that question, but I just
Yes.
want to add to what Viren said about single specialty, right? One of the reasons why private equity funds like the business model is because just from a return on capital employed point of view, it's just a lot more efficient, partly because the per bed cost is a lot lower. Break even happens much faster. We're looking at ROCEs north of 30% when multi specialties are in the high teens. We're looking at EBITDA margins north of 25% when multi specialty are south of that. And also, the only way to really push modern cancer care or cataract operations or save babies is to somehow figure out a low capex way to build that capacity in tier 1 cities, tier 2 cities, which cannot really support a 1,000-bed hospital, right? And so there is a nice happy intersection of demand and supply, and the economics make a lot of sense. So that's why, but I do agree that it's easier to develop a pro forma for a single specialty as opposed to a general hospital with 20 specialties under the one roof. But coming to the CDMO question,
So actually, Hari, before that, can you just explain to everyone what CDMO is as well?
okay,
Yes.
so basically, in pharmaceuticals, sometimes companies that actually sell the final dosage form or the medicine, the capsule or the tablet or the injection, don't want to really use their in-house capacity to develop the final product. So they outsource that function. And generally speaking, depending on the strategic importance, so let's divide up pharmaceuticals into patented medicines. So excuse me to the audience for taking you down like a crash course in pharma, but you have patented medicines and then medicines whose patents have expired, so they're called generics, but they're still very, very effective clinically, right? It's just that because the exclusivity is gone, anybody else can make it and sell it, as long as they can prove that the generic is identical to the original reference product, right? Now, when it comes to patented drugs, generally speaking, innovators like to do everything in-house. They just outsource very tiny slices of that whole development process. But when it comes to generics, a lot of times companies just prefer to sell them and they want to outsource the entire activity of developing the generic version, manufacturing it, and in between development and manufacturing, you need to get regulators from all over the world to really approve that product, right? And they need to prove that this product is identical to the reference. So that whole slice is called CRDMO. In the old days, people here 20 years ago, they used to be, Economic Times used to have headlines about CRAMS, contract research. That has now been rebranded, reworded. They call it CDMO. It's exactly the same thing. Now, coming to your question, somewhere in the 2010s, China put in a lot of capacity, and they got a lot of business from Western pharma companies to develop these versions, the generic versions. And then at some point in time, a few years ago, China fell out of favor, right? So some of that business is moving to India. But traditionally, though, India has always been a very important player in the overall generics value chain, and that continues. So I think it's just now additional tailwind because of China falling out of favor. But what has happened in the last decade is a lot of the Indian companies who started off as pure play services have now evolved into full-fledged, fully integrated formulation players. So, for example, we did Gland Pharma, which is now listed from our Fund 1. At that point in time, they used to develop generic injectable versions, and then they would, enter into marketing partnerships with pharma companies all over the world to sell them. So when we invested, we said, no, you got to stop doing that. You actually can develop your own generic versions and develop your own, file your own dossiers, and then you can capture more of the value. So a lot of the Indian companies have now sort of gone down that path.
Have we got any business from China, away from China,
Yeah,
in this
yeah.
value chain?
Yeah.
Which part? The APIs?
No. So look, there's a general myth that China dominates APIs. Actually,
That is a very big myth.
yeah,
actually.
but they actually dominate large, thousands of tons commodity APIs. A lot of the more complex structures, complex chemistries are actually done, manufactured in India.
You mean like fermentation based?
So fermentation, a lot of the fermentation intermediates China makes, and then there's multiple steps that happen after that. So for example, if you take a statin, the most basic statin, lovastatin, was a fermentation derived, but all the others after that, simvastatin, atorvastatin, rosuvastatin, they're all basically chemical moieties added from the ferment. So China still dominates the fermentation part.
Okay.
But there's then many drugs which really don't require that step. So yeah, so whether it's API development or formulation development or the entire dossier, Indian companies have really mastered that. And so now and just to give an example to the audience, in injectables, just to increase 1% market share of the global CDMO services business for injectables, Indian injectable industry has to double its capacity. So that's how underpenetrated it is at the moment.
Okay. Well, that's very helpful. And we're just switching gears to the last segment. Technology has been a big part of the quarterly updates whenever we read about Narayana Health. It's across the board that you're implementing it just for your internal operations, but also client facing. Can you share a bit about the key technology initiatives you're taking place internally within your organization right now?
Yeah. See, one of the challenges that we have in this business is manpower cost increases phenomenally every year because the Indian doctor is a globally fungible product. They can get work in the Middle East, they can work in the US, and they're always comparing what they're earning here versus what their batchmates are earning abroad. And so you have to match them rupee for dollar, not even adjusted for PPP. Nurses have huge amount of attrition, so you need to pay them well. Nearly a lot of our input costs are dollarized. All our MRIs, our CTs, our stents, our valves, all of that is imported. So that is dollarized. The construction costs escalate by a huge amount. And so the other hand, a lot of our payers, so the government is a huge payer, the government rates have not been reimbursed, have not changed in the past 12 years. Private insurers, they only negotiate once every 3 years, and even when they do, it's not great. So you do have a lot of volume coming in, that no problem. But this is a services business. You have a huge amount of input costs that's required to take care of that, and that grows faster than inflation does. So what are the levers for cost reduction? A little bit of supply chain modification you can do here. You can switch from US to China. You can do from China to India. Maybe you can make some difference in the margin, but you cannot touch the biggest line item, which is salary cost. So the only other option left for a services provider is using technology to reduce the number of either the people you need or reduce the number of unnecessary steps that are required. And since we're headquartered in Bangalore and we're fortunate to be located in a place where there's huge amount of talent available, it was very obvious for us to say, fine, let us truly use what digitization is and use it to transform the way people think about a hospital. So hospitals across the world, I'm not saying an India phenomenon, I'm not saying India hospital phenomenon, hospitals across the world, go to US, Europe, UK, wherever you want, the technology stack we use is archaic. It's archaic in a sense that not only from what the back-end technology looks like, it's archaic in terms of simple things that you cannot do. You cannot book appointments online. You cannot check, just like how I order something on Swiggy and I'll know up to when it's left the restaurant, I'll know where the driver is. You won't get to know that about your blood test, even though a lot of the precursors are fundamentally the same. So a lot of our investment in technology is around improving the overall patient experience in making things move faster, just so that we can keep pushing against the inflationary cost curve. Because again, in India, we're a very consumer-focused payer environment, where your payers are absolutely not going to pay for your inefficiencies, unlike in the Western markets where it's all very stabilized, where it's, everyone sits together, we understand that we can sit and negotiate and every cost increase is met year on year. In India, you don't have that. It is a dog-eat-dog gladiatorial combat session with payers, providers, and customers all at the same time. And so why we need digitization is without this,
There's simply no reason to expect that, as Hari mentioned, to go out from tier 1 cities to tier 2, tier 3, tier 4 and meet the market where they are. Why are all the hospitals concentrated in tier 1 cities? It's what that person said about the bank robber. That's where all the money is. No one is going into tier 2 and tier 3 cities unless payment is solved. Payment will not be solved. The supply has to grow faster than people's ability to afford it. And you can't expect the country to grow rich overnight. Even countries that are rich are not providing universal healthcare for their citizens. So the only way you can do is, okay, fine, let me barterify my services. Now you're offering something that's a premier product, your heart surgery at the very highest levels of skill and competence. You can't compromise on any of that. So the only thing that's left is fine. All the other small things, the nurse ordering a medicine or the patient ordering a test or one person who can only process 4 files an hour. Can you make it 4 files a minute? That is the incredible need that digitization can help solve. And there was not a single software provider who was interested in looking at the India market. And so
have you built a lot of these softwares in-house?
we had no choice. Not that we wanted to. We begged. We begged and begged all the top software providers based in Bangalore, who are all friends of ours and all located within 5 minutes of our campus. They said, absolutely not, because how much can you pay? When they're earning multi-billion-dollar contracts doing back-end, back-office work for the large US EMR companies, 10 million, 50 million, who cares? The whole India market will not add up to 1 billion of healthcare IT expenditure. It's simply not worth it.
It'll be interesting to see where your initiatives leads the industry overall as well, because right now on the private equity side with some of the larger players, we are seeing deal flow which is focused on servicing healthcare firms in the US. So sitting here in India, there's a big thesis of IT or healthcare services in the US that we're solving for. So it'll be interesting to see how it plays out in India as well. Hari, in your portfolio company, any 1 or 2 examples you want to give where technology has really transformed the way delivery is happening? Medibuddy, I guess, is a good example, right?
Yeah, Medibuddy in Fund 3. So Medibuddy is India's largest full stack e-health. So it starts from consultation all the way to medicines being delivered at your doorstep in a seamless fashion. But in Fund 4, in which Waterfield is invested, we have a very exciting health tech company called ABI Health. So they have a product called Claimbook. So it doesn't directly address Viren's pain points of clinical care and nursing, but it does address a part of the patient's journey. So usually when they're admitted, they need a if they're insured, they need a pre-authorization. And before discharge, sometimes discharge is delayed by hours because the billing and the insurance hasn't been settled. And so what Claimbook does, it's fully automated. It's agentic AI-based platform, and it dramatically reduces the need for human intervention. So it has cut down discharge time. And also in healthcare, especially outside the big corporate networks, a lot of the small, mid-size enterprises, providers, struggle with working capital because now about 40% of their caseload is insured. And sometimes it takes them 6 months to collect. And that's because claims processing is highly manual. So what Claimbook does is it has reduced that by almost 60%. And so they collect faster. So the strain on working capital is not so huge. And so then they're able to really grow a little faster because they don't have that drag on capital. So yeah, I mean, these are 2 examples of tech that we've backed, which we think will make a dent in healthcare in India.
Great, thanks. I think with that, I'll wrap up the panel.
I forgot to thank Abhishek and Rohan and Vaibhav and the entire team, Neeta, Vivek, Soumya, and the whole Waterfield team. They're fantastic partners, and thank you very much for partnering with us, but also thank you for having us here today.
And thank you very much for taking the time out today.